China has seen one hit after another in recent months. First, July economic data, including retail sales and industrial production, largely missed expectations. Then, the unemployment figure for young people soared to record highs. Shortly after, the government stopped releasing the data. The economy is now in deflation, with July consumer prices declining for the first time in over 2 years. Could these deflationary pressures derail China's economic recovery?
When we talk about deflation, it is the phenomenon where prices are broadly falling in an economy. And if you think about it, that actually means that the demand is likely fairly weak compared to the supply side of the economy. And this means that something is suboptimal in the economy. Usually you see deflation during a recession, and this is not something that we're looking for. Now, China has gone through brief periods of deflation before in the past. It's come out of it. But what we really don't want to see at this point in time is for China to enter into what we call a deflationary spiral. And what that means is that when consumers expect prices to fall over time, they hold back consumption because their money can buy more goods at a later point in time. Now, if you think of what's the cause of deflation, which is weak demand, this is exactly the kind of behavior you don't want to see.
Investors are closely watching China's property sector in the hopes that the liquidity issues facing China's developers don't spill over into other parts of the economy. The once healthy property developer Country Garden is verging on the brink of default, even as troubled property giant Evergrande filed for bankruptcy.
With the property market, there are two aspects of risks. One is a balance sheet risk, so to speak, and this pertains to not just the balance sheets of households where they're looking at how much their property is worth. Do they feel that they've been adversely affected in terms of their wealth building? It's also the balance sheet of developers themselves. Are they solvent or not? And our suspicion is a good few of them already have a solvency crisis. So it's no longer just a liquidity crunch. Whereas when you already have a solvency crisis, flushing with liquidity only gives you some reprieve in terms of allowing you some kind of financing cash flows. Whereas if you can't restore your so-called operating cash flows where people have confidence to buy property and hence start a virtuous cash flow cycle that allows developers to pay downstream and then feed the wider system, you could actually see cash flows seizing up. So we don't know how far this could ripple.
With all this uncertainty, is it time for investors to pull out of China? The answer could depend on your investment horizon.
Investors should have a long-term strategy. And if you are very well diversified, China will be part of your portfolio. And we think that the long-term outlook for China likely will be fairly resilient. Now, at this point in time, we think that the recent credit events in China likely warrant caution, but not panic. And it is likely premature, in our view, to conclude that we will see a systemic crisis in China at this point in time. And we think that investors should focus on building portfolio resilience to ensure that they can withstand some near-term volatility ahead, and also carefully manage risk. For instance, the lack of diversification, excessive leverage. So these are things to watch for. And as for Chinese assets, on one hand, we think that some degree of risk management is important, given the higher risk in China right now. But on the other hand, asset prices in Chinese markets are very subdued, fairly depressed. And I would say it reflects a high degree of investor pessimism. So the risk-reward does balance out in that regard.
But is it all doom and gloom, or are there some bright spots for investors to watch?
For an economy of the size of China, there's always a silver lining. Yeah, I mean, frankly speaking, you can think of sectors, maybe even sectors that have become very cheap because of maybe specific crackdown. It may happen with the health sector. suddenly valuations go down a lot, and you know that China needs help because of aging. So, there's always positive stories. If you talk about the macro picture, generally, not sector, of course, in my humble opinion, unless a big stimulus, monetary and fiscal happens, the year will be slightly underwhelming. Maybe 5% growth, not too bad. We cannot expect China to grow as it used to. And it will never grow as it used to because it's becoming richer. No rich country grows 8% a year. So, I feel like sometimes investors, in a way, look for the past. They don't think about the future.
One thing that all experts agree on is that China's central government needs to do more to stabilize the property sector and stimulate growth. Investors need a clear sign of confidence if they are to stay invested.
Beijing will probably need to restore certain critical components before investors can take heart. One of it is the ability to revive property sales. It appears very fundamental, but to us that means two things. That means A, you can restore cash flows and critically operating cash flows in the economy. And so the chances of getting a seizure and one that can cause a contagion starts to step down. So that's why we look for it. And it also, more importantly, might underscore that some confidence is recovering for people to put their money back into property. So for us, because of the confidence in the cash flow issue, that's one thing that we look for. Are we looking for deflation to dissipate? That might be encouraging, but it's not sufficient, mainly because given El Nino and many other cost shocks along the way, just getting out of deflation doesn't mean you're out of the woods.
In China, it's very important to look at signals, data disappearing, or sometimes redefinitions, but also on the positive. If you see that on the industrial policy side, if you look at specific sector being continuously mentioned, whether it's 5-year plans or Made in China 2025, now the 10,000 little giants for small and medium enterprises. Well, you go for it because if it's a new sector and a lot of money is going to be put there, it's hard to get it wrong. So you need to be quite granular to understand China. It's not just looking at a couple of graphs. That's not the way China works.